Well, hello and welcome to More Talk, the season 2 finale, where I posted and you can see on Spotify and Google Play. If you're listening, please give us a like, a follow, a subscribe, even a comment. We have had a fantastic lineup. I went through the season on my recent post and all the great guests we've had. And today we really do want to take a deep dive into it. And we also want to get into, or I want to get into two what I find major articles this week that I think do need some attention. They are a little bit controversial in what they say, these two articles for the mortgage industry. And so I think this is the only place where you really see it because we don't have sponsors that would keep this. I shouldn't say sponsors. We don't have these paid advertisements and these large,
Right.
media responsibilities where there's some names mentioned in, especially that USA Today article. So what time do you want to get into something like that, Mike? Do you want to get into it a little bit later and kind of go through your list of the season recap?
Yeah, but let's just tell about all of our listeners that are on Spotify. We do this show live every Thursday morning at 11 a.m. Pacific, and
2 p.m. Eastern time on LinkedIn Audio. You just use the hashtag MoreTalk, More Talk. Though the name could be changing, but that's how you find the old shows, and we'll keep using that same hashtag so you can find our live show.
absolutely. This season, compared to our first season, I mean, great job on lining up all of the speakers. I mentioned in my repost that it's from the smaller broker down to the millionaire banker is really across the board, right?
Yeah, it almost took a trajectory, right? Like when you look at it at first, we were dealing with people on the ground floor, Greg
Mhm.
Harris and Christine Beckwith dealing with those brokers and helping generate business.
Mhm.
We did have a great holiday special there, but then we went right to Sue and Matt, and that's credit scores and sales processes. And by the end, we were dealing with IMB owners, right? And getting a pulse there.
And not only IMB owners, but one thing I thought was really interesting in our last show with Courtney and Paul was that we had a chance to merge sales and ops together to figure out how they can work to create more sales. It's not too often that you'll get the sales team leaders working with ops on creating future sales. And for them to work together on that one is with CMG was special for them, but I thought it was very interesting from an interview standpoint as well.
I was talking with people because I think the big part of that show is they're up 19%,
Hmm.
right? When the rest of the market's down. They did acquire Homebridge, I found out. That was a large acquisition that really helped there. Is
Hmm.
growth through acquisition or is it through marketing? It seems like the theme right now is growth is more through acquisition. I don't think we had many guests that would tell us that it was through finding a eureka moment in marketing.
No, nobody decided to divide and conquer. They're deciding to buy and conquer. It reminds me of when I would read the news in college of how there would be leveraged buyouts, and I think we're at the age right now where we're in leveraged buyouts. The real question in a few years from now is, are the middle managers going to stick around, or are they going to get laid off just because do they need to be around? There's no transition anymore. So it'll be interesting after the transition period in the next few years to see if the middle managers will still be needed in the regional areas.
How do you expand? The only way you can offset that middle management income, this is my takeaway from the season. I don't think you can go to them and say, you're going to make less. They can kind of move their groups with them, right? Their management is motivating and moving. So the only way you're going to do it is better marketing and having a better marketing first strategy or digitizing a lot of the area where you have manual effort and teaching these loan officers with digital labor. They could be their own middle managers, but that's kind of the opposite when you say, Mike, of another theme where nobody was saying it, but LO comp is difficult to maintain in this market, right?
Yep.
And so if you're going to say, okay, we'll take some away from middle management, the LO's going to say, well, then why would my income go that way, right? Wouldn't it be more?
I think it was just after we interviewed Eddie Perez, and then when Chrissy was talking about it with Bill Dallas, we were talking about the economy of scale as an originator, right? The more loans you do, actually, your overall, your gross compensation is going to increase, but your overall revenue per mortgage loan actually decreases because after you invest a certain dollar amount into generating more business, right? You're spending more marketing dollars. Maybe you get an assistant, and all of a sudden you're doing more business, and everything is looking good. And then you look at it and go, "Wait a second, I was earning 100 basis points before, but now I'm only making 60 basis points. But instead of doing 2 to 3 loans, I'm doing 7 to 12 loans." And so you're like, yes, my income has grown and I have a better life. I'm just earning less, but I'm okay with that because I'm investing in the business. And I think that's actually what's going on today with the independent mortgage banker, right? They're going out and they're buying profitable businesses or businesses that can be fixed and flipped. And then they're looking at it and going, okay, this is what we can do. And maybe we don't make as more per mortgage loan, but we can create efficiencies to still be more profitable. And I think that's the big key when looking at all of the people that we've spoken to this past season is what can they do to stay in their lane, be more efficient, and then produce more revenue. And I think that's, as we go down the amount of people that we have spoken to, and I want to, maybe we can take 1 to 2 minutes per episode and just kind of give a highlight of what we thought, what was the big for each show of the season.
Yeah, we can definitely do that. I would say one of the takeaways I have of where the market's going, and it's on the real estate side as well. I was trying to look up, there's some facts recently released, but to me, you have great leaders like Bobby Nicely, Suzanne Livingston, and Chrissy Ray, who are very comfortable, are not necessarily in M&A mode the way Dan Snyder was from Lower on the last call, right?
Right.
They organically have built and don't necessarily have the mandate to go out there and grow and scale. In the real estate world, they just released, 50% of the agents, I think there was 1,600 of them, 16,000, that would be in the 1.6 million of them, right? Now there's 800,000 less left, let's say. I guess the bottom 50% only do 1 to 2 deals. Yes, that's sort of where we're going to get with this. And so Housing Wire's actually doing something with Tom Ferry that'll be coming out very soon, where they're going to break down the growth of the top 20% versus the middle versus that bottom percentage over the last 5 to 10 years using Altos Resource or all the new data that Housing Wire has. And I think you'll see similar results in mortgage. And what the thesis they believe is they have to prove yes will be because of automation, because of AI, because of data, because of skill set, whatever that is, and branding, right? And social media and branding, that top 20% has exponentially grown their business while the middle still struggles to figure out how to scale up their business and the bottom is just non-existent. And so if that same trend occurs in mortgage, I think you have to start asking yourself, how much more powerful are the loan officers that are in the top 20% going to be 5 years from now? And how will that change if it's a recruit first world, right?
I got a question for you. As you're saying that, and I'm thinking to myself, okay, that means that, to me, this is how I translate it in my brain, is that the top 20% are having people call them, but the bottom 75, whether you're a middle market or lower or market or middle producer or lower producer, you have to make the phone calls if you're in the bottom 75, and you don't have to make as many phone calls if you're in the top 25. That's what it translates to me. And I think that if you're using AI,
it could be through automation, could be through social media, right?
Yep.
And branding and perceived branding. It could be through understanding account-based marketing and where many people are now using, and it's only going to get more powerful. Like my LinkedIn feed now, where I'm trying to get better so that I can speak at these, MBA events. I think the only place people really need to hear is the ability to find intent, scrape through a software like Clay that just popped out 6 months ago, built on ChatGPT. They're all built on these AI marketing tools, right?
Right.
Automatically does all the research, categorizes it. From there, you're going out there and trying to generate action. Black belt would be Google ads, Facebook ads, right? Which we'll get into the Facebook article in a minute. And then the growth of your database, branding, social media, etc. So these loan officers that are top 100 are just going to keep growing, in my opinion, right? And therefore, I think it's going to have a big say on leadership, on how they look at how important these loan officers are. Like I guess my point is, and we'll go through these now. It's easy to say LO comp needs to go down, but it's hard to say it when these strong ones are becoming so much stronger. Wouldn't you argue they deserve it?
Oh boy, I'm not sure about that one. There's a few top producers out here in San Diego who have traditionally done, over 100 some odd $1 million in business. And I've met their teams before, and I see how they're doing their business, and they are still doing over $100 million in business, but they're effectively buying that business with the prospective lender that they're working with. And I think I'll agree to disagree with you on, for the most part, yes. If you're a large producer, like, doing whatever, 30 plus units a month as a team, I'm going to question that. I think that the business model it's a machine business model. It doesn't really matter. It's always going to be the same. The company's not going to make a lot of margin on it. That team's always going to produce, and that's that they're going to get bought out because of their name and so on and so forth. But that's kind of part of the deal.
Yeah, no, that makes sense. I'm under the assumption the rules of the game are GSE loans, right?
Mhm.
And digital labor is going to replace manual labor on the origination, and therefore loan officers are going to become like RoboCops or Iron Man. But let's jump through it. So episode 1 was Greg Harris, who was building a portal so that smaller companies could get what Lending Tree offers, right? Buy leads
Right.
smaller. And then Christine Beckwith was on the show, and she really said the market hasn't changed that much. If you just use old school techniques, behaviors, and attitudes, you'll convert.
I thought it was a great show to start off the foundation of the season, only because it's like, number one, get out there and market. Whether you're on the phones or whether you're shaking hands and kissing babies, you got to get out and go do your thing. And I think that goes not only for the individual loan officer, not only for the team, but also for the recruiters and also leaders and executives that are looking to expand as well. Going to the last episode, Roy talked about how when he recruited a team out on the East Coast, that was because he made a phone call. And I think that it's the same way that goes for an originator. Hey, I got this loan because I made a phone call to somebody that maybe I normally wouldn't have made a phone call to. And so Christine just hit that foundation, got to make those phone calls, and you got to go press the flesh and meet the people in order to make the sales, make the recruits, and grow the business.
It's scalable too. It just brought me back to an old place. It's like call financial planners, right?
Yes.
And these are the activities you need to do. You need to remind yourself that they're in your sphere of influence. And then it goes back to like what you say, Mike. There's little details that you can make a lot of money on. Like financial planners can't tell you to take money out of your home. They can tell you what to do with it. And there's so much equity out there. If you could connect those dots, right? And the only way you can do it is come up with a plan, but then you got to go do what Christine's saying versus just posting it on LinkedIn. And it's scalable too. Like you need a lot of loan officers doing it or team members doing it. Very difficult to maintain calling by yourself.
Yeah, just a quick story. When I first started in the business, is everyone was calling realtors, and I was like, "Sure, This is back in the '90s, right? Doing subprime loans, so I'm like, I'm gonna call collection agencies. I'm gonna call bail bondsmen. I'm gonna call all the finance companies that were buying the private money loans, and then they would need to get paid off because subprime lending back then was a little bit more easy to do, so I could refinance those loans. I would just call everybody that everybody was not calling. I would even call the competitors, because they were like, whatever reason. And so I think that, again, getting out there and calling the people, financial advisors eventually, and then estate planning attorneys and, RIAs and so on and so forth in the future as a broker. But, that's what you got to do if you want to go from 2 to 3 loans a month up to 8 to 12 loans.
Yeah, absolutely. And we had a great episode with Jordan, We talked about how important it is networking, showing up, and it doesn't just have to be at the national level. I'll be at the New York secondary next week, but
Uh-huh.
I think we heard some good stories of local with our holiday special where Russell Pulliam was talking about, I'm trying to remember here. So Tim Allen and Russell Pulliam had
Mhm.
two holiday stories, right? Do you remember what they were? One was, and they definitely both were about giving. One was in Florida about, it was like their 19th year. Was it getting
Mhm.
gifts for like Toys for Tots? Is that what it was?
It was Toys for Tots, and they've been doing it for a number of years, actually. And so I don't remember the exact story, but the fact that when there's cutbacks and layoffs and all these things that are happening, that they still have the mind to say, this is what we're doing to give every year. I think Russ was talking about how he would go with his family. Didn't they make it a tradition, like him and his wife and his kids? They said, instead of us giving gifts to each other, we're going to give gifts to other people. Do you remember that?
Yeah, I
Something
think
like
he,
that.
he talked to something about because we brought him on because he had a story about ringing the bell
Mm,
and trying things he hadn't done before. And he rang the bell for Salvation Army for the first time. And he said it was only for an hour, but the impact, was going to last him for a lifetime. And how just there's lonely folks out there and the simple smile and, look in their eyes and Merry Christmas, he said, made a difference. And
mhm.
just how he learned about judging a book by his cover. Some people he thought wouldn't donate, didn't,
Right.
donated very generously. And people he assumed had money wouldn't donate. And yeah, he talked about it's better to give than receive. And I think that's where you and him were talking about that. I believe that was Russell.
Yeah,
And
I've
then,
given more this year than other years just after that show, actually. That came out wrong. But there but there's something to be said about not just feeling good, but just the fact that you're giving away what you want to do for yourself for other people. And it's not because you want to feel good, it's because you're giving for the sake of giving.
people should go back to that show. I think you gave, especially with your not just faith, but the fact that you keep going back to it, or I should say, just you're active in it, right? And so I think you were very powerful on that show. That was episode 2 for those following. Episode 3 was with Sue Buswell and Matt Slonaker. So episode 3, Sue knows best. Sue knows the score. I actually feel guilty. We haven't, brought her back. With some
Me
of the
too.
people. You got to remember who you see, on the way up, right? I just think for our general audience, if you're looking for a home, that episode 3 was just so powerful. In 20 minutes, she broke down what she broke down really well was how you can now go on one of those FICO websites and get your real credit report that they
Hmm.
use with mortgage scores. So if a loan officer tells you it's not going to be your score for mortgage, not their fault. That was what we've said for 15, 18 years, but it's finally available and you get to pull it once a year. And if you pay for it, I actually think, there's some transferability to it, or it's just an episode you should go back before I speak out of line.
Yeah. I think that, well, here's the key. You can do that as a soft pull and not a hard pull. That's what I got from that show. So a hard
Yes.
pull not only affects your score, but it shows up that on a historical report that this was a pull. But you can go get your actual score that the lenders are going to use off of the bureaus. You pay for it, but go get that score and not have a hard pull. That was the key that you could take to other lenders and say, this is my actual score, not Vantage 3, not Vantage 8, but the one that you're going to be using. What can you do with this report, with this history? And instead of shopping yourself and having the lender pay $40 a shot, a consumer can go out, pay for the report, shop themselves if once they've chosen, the lenders they want to work with and interview with, and figure out what is the best type of financing for them based upon the originator they want to work with. And putting that power back in the consumer's hands and Sue teaching about that is powerful.
Yeah. And then Matt Slonaker is really a well-renowned, sales trainer,
Hmm.
uh, unbelievable background, especially in servicing, loss mitigation, default. And he touches a little bit on it, but and he's had a book come out in the last week or two, on
I didn't know
Amazon
that.
and everything. So I would highly recommend, checking out episode 3 there.
Yep.
Why don't we do episode 8 here, right? And then I do want to say the first one of the two real, like, I think, I don't want to call it controversial, but we can get raw on 2 articles that have come out that are very, going to change the mortgage industry a little bit here and there.
Well, we can kind of merge episodes 8, 9, 10 a little bit, only because we're talking. We can talk about brokers. We can talk about the ability to recruit and the recruit ability to grow, and what we need to do. Especially, Laura Brando coming out and speaking with John. That was I remember that was I had a great time on the mic drop afterwards, because it was so it's like, go out and do your job. Go make the phone calls. Go make the same thing with episode 1. Go out, do your job, make the phone calls. And then if you're an owner of a broker shop, and then when we're talking to Steve Richmond and Steve Katz, you got to know your product. You got to, know your guidelines so you can work with your people so they can get deals done. Because in talking to them, they really, that wasn't about originating new business. That was about knowing your product and getting the job done. Talking to your reps and getting things done. Those are great examples of what to do at the beginning of the season, how to work on your business, and then when talking to John Jerkovich and Steve Richmond and Steve Katz, how to work in your business. And I think when you differentiate the two, there's times to work on your business and then work in your business. Then you're figuring out what you do for marketing and then what you do to work on systems.
I mean, said very well. Very well. And the responsibility of a loan officer, just to stay grounded in this virtual world, that there are loan officers out there that can go to a supermarket and people know that they're the local loan officer because they know the people's family names. They have helped people that are referable on different programs where they feel like the loan officer did more than just sold rate. And that is where it does make a difference. And I think that was told very well, right? Now, while I know which article I want to do. While we have Michael McAllister in the audience, maybe
all right,
come up on stage.
Let's do it.
Pressure, Mike. So USA Today came out with an article. I don't know if you saw it, Mike. I didn't have a chance to tell you it, but it's a big deal. Mortgage brokers sent people.
What you're talking about. Tell me.
Okay, here we go. May 15th, right? USA Today. So if it's in the USA Today, typically the CFPB reacts to it. I mean, that's just first thing to say, right? So what I've been told. So mortgage brokers send people's estimated credit, address, and veteran status to Facebook, which is a mess for both Meta and for companies. First, it talks about Fairway Independent Corp. Offers mortgage options across the U.S. The markup found the company website using the Meta Pixel. That's what I mean, that's maybe we have to do it another episode, but I got to figure out more how this Meta Pixel works. But there's some pretty well-known companies here. So the Meta Pixel tracked detailed information about visitors, including every button they clicked on a pre-approval page. So I'm not going to name any of the point-of-sale companies, but are the point-of-sale companies part of this? Like, that's why I don't get the Pixel, and I'm not asking anybody to come up and say names, but if you know how Pixels work, I want to explain a little bit. To track detailed information about the visitors, including every button they clicked on a pre-approval page, the type of home they were interested in. It even tracked a question where they estimated their credit as poor or less than 580 to excellent, more than 740. It also sent Facebook a scrambled version of the visitor's name and email address. Meta says these hashed email addresses help protect user privacy. But it's simple to determine the big word here, obfuscated version of the data. And then, one of them is MRC, Mortgage Research Center, which is part of Veterans United, right? And they actually do the calculator on Realtor.com. I'm not even just going to give you, and there's other lenders mentioned here. That was just, I didn't randomly pick it. That was the first lender there.
Sure.
They own the Realtor.com calculator. When you were filling that out, they were sending it to Facebook. Now, if you recall, about 6 years ago.
Wait. Can you stop back and talk to me like a 10-year-old here? Because you didn't lose me, but I want to make sure I understand what's going on. So if someone goes on to, for example, the Realtor.com website, starts typing in numbers, the minute that they start typing in, they're collecting the IP address. That IP address maybe even will have a location on it. And then they're filling out the information. All this is being collected, and not a cookie. It's a pixel, and all that's being collected, the consumer data, as they're filling it in live, is being sent to Meta?
Yes, according to this article. Some were even sending, what is the page where you check like in your point of sale, bankruptcy in the last 7 years, race, ethnicity,
Yeah, those are the government monitoring questions on the last page of your 1003.
one of the companies in here, you know, they did that too. Now they're all saying that when they got to Meta, those were left blank. But and this is on USA Today, so it's not like I'm finding some obscure article to like
Yeah,
drag these companies through the mud. But
yeah.
Veterans United Home Loans use the
Wow.
Meta Pixel for its online loan calculator, telling Facebook whether visitors are homeowners or even what branch of the military they served in. The company also tracked personal information, including full name, phone number, but those fields show up blank when the data goes to Facebook. It's not clear whether this is intentional. So, clearly this is for marketing, right? It must be like, and I think the question is
Is this
it
good
for,
marketing or bad marketing?
I think the question is like, obviously retargeting works. I'm a huge fan of retargeting. They took this all out of Facebook like 8 years ago, so you couldn't do lookalike audiences because the more you looked at the more you technically were not being, you could then be a little bit discriminatory. Here comes Mike. Maybe he can just, without saying anybody individually, just explain how a metapixel works and
Yes, please.
help us out, Mike.
Hey guys, sorry you got me sucked in, Michael. You started talking about pixels.
Did you see this article, or is this the first you're hearing of it?
No, this is the first I'm hearing about it, and I'm interested to read it. I do know like there's a lot of misconception about how this like data collection works, right? So there's a difference between companies consciously like creating custom fields inside, custom data inside of Facebook and sending the actual credit scores and sending the actual like homeowner status and the actual like answers to these fields. There's a difference between that and having the pixel on your site, which tracks clicks onto and it tracks clicks to elements, right? It doesn't track like it's not reading what all those fields are, interpreting that, and then putting that into a format that's usable. It's just tracking the interaction with your site, right? And so unless you tell Facebook that that's what those things mean, which I do this quite a bit, and I don't know of an easy infrastructure to do that. Especially if you're running if you did pass that data, then they wouldn't let you use it in your like finance-based ads. So I just have a hard time believing that it's actually like a collection of that data, a processing of that data, and a passing of that data where it can be processed again from Facebook versus just like a misunderstanding and like feeding into people's, lack of knowledge about how this stuff works.
If it is a lack of understanding, which if I was doing it, that's what it would be. So like I wouldn't know, right? You would just put the pixel on the site because you're told that that's a good thing to do. Now, if you don't fill out, let's take the type of military that they're sending over. You're saying if you don't fill out a custom field on the Facebook side that says type of military XYZ, then the lender at least can say they weren't really acting on it. And then the real issue is, it was Facebook smart enough to figure out how to, they were still getting that though, right?
I mean, they have the opportunity to, right? I mean, when you put a pixel on your website, it's like it's recording everything that's taking place on your website. But the way that data is structured is not automatic that data is going to be used. And this is something that's been around for a long time, right? And so, that's like the same thing with like smart speakers, right? That's why smart speakers are allowed to be on and technically have their microphone on because they don't actually collect that and process it in such a way that they can sort that out and associate it to the individual and do all this stuff. So there's I feel like a lot of gray area that's existed in data collection, like technical data collection, because of that. Now, I'm not saying that there's not some like bigger conspiracy that some of these companies do have ways to actually do like act on this. And if that's what the article was saying, I wouldn't be like extremely surprised by that. But it doesn't inherit like the fact that they could potentially like collect and interpret this data doesn't mean they automatically are. And it doesn't mean that these companies are sending it to them in an attempt to use that data.
I think you're right. I mean, I don't know. It seems to me like it was just a little bit of not realizing the implications of it. And now, USA Today, it's just another probably cost to the mortgage process, unfortunately, that will drive it up because of compliance and regulatory. I mean, that's what I think. I want to give them a chance here.
It just screams violations all over the place.
Yeah, let me just get this quote out here for Fairway Son.
All right.
I want to be fair to them. Kristen Bradley, the chief content officer for Fairway Mortgage, said in an email response to the questions, the markup, the company has stopped using the pixel. She said credit estimates shared with Facebook were not scores, but rather categories made up completely by the respondent based on nothing but their feeling at the time. And they did not collect or transmit personally identifiable information during the time the pixel was in use, but declined to detail how the company defines such information. I mean, LendingTree was involved here. So its website sent data to Facebook through the MetaPixel. When we filled out the mortgage search form, the data included a unique ID as well as information on co-borrower, bankruptcy, home ownership, military history. So it's just some of the trades are working on it. And so I found that out. And I think you're going to hear a lot more of it because, again, I mean, this is bigger than this is in the USA Today. And that's generally where a lot of customers, right, mortgage customers read their information. And I don't think these days it's a very big newspaper. It's probably like 10 pages, right?
I'm reading this article right now, and it definitely sounds like more serious. It definitely sounds like they're in, like, Fairway, even the way that they address it makes it sound like they knew that they were passing data to them. But it doesn't make sense to me because other than whenever Facebook got slapped with those sanctions from HUD, or that they got slapped by HUD and said, you guys can't use this data to target people. Like, Facebook intentionally makes it so that you can't use that type of data in your targeting. So I don't know if this was like before that, or if there's some bigger conspiracy that I don't know about.
I think that would be like the only real thing, right? If this was just a workaround. And so pixels to me come off as something that can be accidentally done, right? Like, put this pixel on your website so that it integrates better with Facebook. But then again, I could be naive. I guess if you're running a company serving that many homeowners, maybe there's a larger pedigree needed to know about Facebook pixels.
I didn't even know this was a thing until you mentioned it, by the way, guys. I'm kind of shocked.
We've had some talks about retargeting.
I mean, look, this same group did it to 3 other industries, and the FTC came down on all 3. So that's what this group does. And the FTC doesn't like it when they hear about it. Meaning the same thing. They used these Facebook pixels in it was like hospitals, and I just had it, but I lost it. That was an article I just wanted to bring to everyone's attention because I've already heard it 3 times, and I've heard it at some pretty high levels.
So you did not see it in Housing Wire at all yet?
I just find it's going to be difficult to, I mean, it's going to have to end up in Housing Wire maybe. It's just there's a lot of companies on here that probably,
customers?
Housing Wire wants to touch it.
Okay, I get it. I'm just asking.
And also, like, the Mortgage Resource Center is part of Veterans United, but that's like a legit, that, is a big lead aggregator. I think their calculator is the one on Realtor.com. That's how they generate those leads. So technically, I think that's the calculator they're talking about that's fed to Facebook. So that's more of and they compete with LendingTree. So maybe it's some tactic that helps convert those leads. Thank you for coming on, Mike. Like, it's a little bit over my head, and I don't want to make any, I don't think anybody really knows, but does that mean the customer probably knows even less, right? They would read it as the average Joe would say, geez, these companies are sending my data to Facebook, who then trades it with Netflix, right? That's viewer history. Crazy.
All right. We can talk about this on another show. I mean, I wish I had done a little bit more research on it, because I'm thinking about all the fair housing, all the consumer credit information that may not have yet been filled out, but then they extrapolate it because, I mean, if Fairway decided to sell that information, I'm only using Fairway, of course, because it's mentioned in the article, and they said, hey, we're going to sell this information. We're not going to tell anybody about it. Or for the borrowers that signed the disclosure that said, please do not share my information, or the ones that didn't care, I don't care if you share my information, all of a sudden that information gets bought and sold because it becomes another profit center for them. And I don't know, by the way, this is all speculation, then this may end up being bigger than even this USA Today article.
Well, what you're
Crazy.
saying now, I think, is what the average person then is probably thinking. Like, right? Like, whatever you're saying now is probably when someone's reading this. They're like, it's just not a good. People were worried about the Ishbia at a United Wholesale.
Yeah.
I think this one kind of is probably
more Main Street.
Yes.
It is definitely more Main Street.
So we had the Greg Schur era, which was episodes 10 and 11.
Yes.
That's when I was out in Marco Island. So Rob Pieklo and Dan Sigorka were on one. And that was a really cool show because, first, Rob Pieklo is a big foundation of us doing this, right?
Yes.
From Clubhouse. But he talked about the acquisition, getting backed by PE money, kind of talking the resurgence of wholesale. And then Dan Sigorka told the story about like creating one of the most successful mortgage tech companies in the industry, which
and then
selling it, which was the ability to really commoditize data around if you wanted to integrate like with Black Knight or any of those services.
Right.
And then he ran Sagent, which was finally for the servicing side, a technology company that became relevant and one of the biggest in the industry still. So that's episode 10. Very cool. I mean, to get Dan Sigorka on is underrated. And then Brian View and Jay Promisco and Greg Schur were on episode 11.
That's when we started to get really raw. That was our turning episode.
That was the rawest. If you want to hear real opinions about vendors, mortgage vendors, and real opinions about what some of the headwinds are in this industry, right? Jay and Greg did not hold back on that one. That is episode 11.
Not only that, but it was only the day after that is when it got publicly announced that Jay got promoted, wasn't it?
Yeah, you're right. Yeah, it was. Yeah, right after that, he was promoted to president. We were like, wow, we had that on there. Actually, no. That was weeks later because he joined us again with Joe Darlene, who's been in the audience, but we'll get to that one in a second. Maybe Joe can come up and talk about episode 15. That was when he came on with Clayton Collins and they were talking about the buyer's agent. What happened after that episode was Eddie Perez, who was absolutely under the radar, crushing it, in wholesale and EPM. The industry as an overview, the change of the guards, and I think he got so raw because episode 11 was so raw, and he said, "Oh, you want raw? Game on. I can get raw." And yeah, I think that one to me just felt awesome. I really enjoyed that show.
I think we're like the heart of the order right now, right? With the last show, and then to Eddie, and then getting Bill Dallas for the next show thereafter. It was like, and then Bill getting raw on what you need to do as an originator to really begin to figure out how to crush it. And then Chrissy chiming in as an IMB leader, asking him questions. We talked about her staying in her lane for what she does as the top USDA originator in the area. And so for him,
that whole show, if you're a loan officer or a branch manager, or processor and say, I can do this.
Yes.
Like that was like an hour and 45 minutes. Next time you're on a road trip or you're going out to visit somebody, anybody in the industry, that's
flying out to secondary.
Yeah. It was just such a game changer to me. Inspirational on how to get there. Yeah. Very, very cool episode.
Then having Tammy Gravely and Chrissy Ray.
No, it was Tammy. Yeah, I messed that one up. Tammy Gravely was on with Andy Harris from.
Yes.
And so you got to see banker and broker, right?
Yes. I was wondering about that when you put that on there. I was like, yeah, because I remember we were talking about Andy being a broker out in Oregon and so on and so forth, and then Tammy being I think she just took her position out there in where is it? And is she also in Tennessee?
Yeah, she was at First Bank, which is a huge correspondent. Now she's over at Bank of Tennessee, correct? It's just a great story about somebody that's been in the industry, worked her way up, and has come to a point in her life where she is giving back to the industry and trying to inspire others on, like, let's be better, or let's be great, or let's be on our, on our A game.
And then can you believe we're at 3/4 left, and we're really gonna have to double time this, Mike.
Well, we had Joe Darlene.
Yep.
He's in the audience now. Joe, you want to talk about your episode? What a great episode that one was. It had everybody talking about the buyer's agent, so much that Clayton Collins, CEO of Housing Wire, to come on and kind of just say what was bothering him, what he was frustrated about. And that's when Jay got real, and that was a week before he became president.
Right.
Just really cool. I mean, when you can have Sam Garcia, who, by the way, people need to tune into Sam Garcia. He's writing about equity. So his his publication now is all about equity.
Mhm.
And I think, that's where the puck's going. Joe, you did really good that episode too, because people were popping on and off during that episode.
Yeah, it was yeah. Everybody got so opinionated in a good way.
I know after you gave a great analogy with your dishwasher.
Yeah, no problem. Thanks a lot. Loved helping you guys out. I really do appreciate it. That's really fun, and thanks very much. Isn't this kind of a big episode for you two, though? This is like the end of the season or something, or what's going on?
Yeah, I mean, we had an amazing season with and we just wanted to recap it. I don't even know if we're going to be able to finish a recap, but
yeah, no, we had a great episode, that's for sure.
Yeah. We hit some of them in reverse order, so I feel like we got 4 to go. But yeah, so next week will be start of season 3.
Okay, great. Okay, good.
And it's going to be a nice little rebrand to it. And it's going to
good.
be a lot more polished on the podcast. And you might see us start hitting the waves on Apple Podcasts too on season 3.
Geez, you guys are all over the place, man. That's awesome.
Yeah.
Well, the real changing point might have been then episode 15. I mean, it was you, Jay, Clayton Collins, Sam Garcia, and I just remember it was almost the whole show was about what would happen with the buyer's agent. And I kind of feel like now we're not any further, like no one's willing to put another opinion on it yet, right?
Yeah. Well, there was a lot of stir when Zillow came out with that 7-day touring, thing, which was kind of interesting, right? I think a lot of people were dumbfounded when they finally were shocked that actually came out. And how does that really change it, right? I mean, Zillow's just saying, let's get you into any house. We're going to do a 7-day thing for you, right? And you can sign this little addendum right here and, try me out for 7 days. I think that's a really good idea, right?
Yeah, and I'll tell you what, Nicole Booth, who not only do I think very highly of, the industry thinks very highly of. She did a great job with, lobbying at Zillow and at Rocket. And now she's at Zillow, and at our state and local, I think Zillow had like 5, but at state and locals right with the advocacy conference. I had never seen them there before. And now they had 5, right? Mm-hmm. Actual people there like lobbying. And to give you an idea, most mortgage companies don't even have 1. They use the MBA, right?
Right.
And they have 5 plus the MBA. And today, that was the other article I was going to say. What is it? This week in their app, somebody said it to me, they figured out LLPAs. And so now they're announcing your buyability plus what you just said. They're going to put a stake in this game of we're going to go for the buyer. And it's real estate agents are worried about being disrupted on the 7-day, the 5-day, 7-day agreement.
Yeah.
The mortgage company doesn't realize it, but this is just as bad because I think they're going to be looking for a big bank. And when they go out there and they give you your quote monthly estimate, it's going to be at almost below market is what I'm being told. Like they'll do the LLPA, they'll take 3 bips off. And so as consumers start to get used to it and then they go out, nobody will ever be able to beat what the app says. That's what the birdie told me from DC. Just saying.
Okay. All right. Well, could be.
So he's saying game on there and then be aware. And it just got real. And the real story is not that the app can do it, but that Zillow has now figured out how to take advantage of LLPAs, which are loan level price adjustments, which are credit score driven increases to offset risk by Fannie and Freddie. And if they can get somebody willing to work with them where maybe it doesn't go directly to Fannie and Freddie, they can get a little bit less risk on that. People are going to be walking around. They're going to put a good in the average W-2, person. They're going to put a pretty good stake in that buyer process.
Right.
And that was the other article I wanted to say. And then that's from a birdie. That's from the birdies, like, the 2 or 3 that
that's really
tipped me off on things.
That's really interesting. So they just, that's almost discriminatory. I mean, isn't it? You can't just serve that type of client, and
Okay. I don't think they're saying that. They're saying if you add your income
yeah,
and you pull your credit score, right, they're going to give you your affordability,
right.
and they're going to give you a monthly payment. I don't even know if they're going to tell you the rate unless you click on the fine print. And you're going to be in a different portal where you're not even really going to see the house, what it's selling for. You're going to start to get used to searching by monthly payments in your affordability. And they're going to show you that as your credit goes up, your LLPAs go down, so you get more monthly payment.
Right.
Yeah.
And soon it will be, how to get the seller to pay closing costs so you know how to buy your rate down, or to go the 2-1 buy down, right? So they'll be the first to explain to you very quickly about how the loan works without talking about the price, without talking about the rate and the closing cost, right? Because really it is a derivative of really what the closing costs are, and then maybe what the seller's going to kick in to make the offer work, right? So I don't know. It is true that that they'll do a better job at educating the client and try to be more transparent because they have the tools to engage people that way. I mean, they already have, 250 million that show up every month. So
Go through our last couple here. But the way I see it, Joe, is you and I both work with Silverwork Solutions. I see that as the winner now, right? And
yeah,
I really do. And I don't. And so all these companies talking about working on their operations and AI and all this investment in there, you don't just go over to Silverwork. But long ago, they haven't gotten anywhere really, right?
Right. No, we have the best technology in the business, and it's the highest cost to produce ever.
That money should have went upstream, and maybe this is a wake-up call. You got to at least try to have better ways to explain 2-to-1 buy downs, and you got to at least try to get it upstream. And if you listen to this episode, you got to try it without using Facebook pixels, right? So so we'll jump in. Our next episode is with Bill Lyons and Jordan Wild, and that was cool because you got somebody that was in the Shark Tank, right, Mike?
Yep, that's right.
He sells like non-GSE. To segue here, Zillow's not going to be able to touch non-GSE loans. That means anybody that has a loan outside of Fannie and Freddie. Fannie and Freddie traditionally means probably better rates because there's less risk. But it doesn't mean that creative loans can't come out. And we talked about, gig economy, cash statements. I think his ability to do call centers, right, and have real people calling on those programs, that was cool.
That knowing that he's actively marketing investors to go not only are they more profitable, but I think they're underutilized, and I think he was expressing that. And so to go from, and he said although profits are down across the board for a lot of companies, I think he had mentioned that he actually had not taken a loss.
That's right, and he's proud of that, right?
Well, yeah. Any company that's in the black right now over the last 2 years, you can hang your hat on that. So that's a big positive thing. Great lesson for Bill and for him to share that. I think that's a little bit of a brag at the same time, but good on him.
And then Jordan talked about the importance of networking, connectivity. He does a lot what I do on the servicing side, and I think, he's just a tremendous resource. And he gave if you're into entrepreneurship, servicing, there's a lot of good episodes here. Episode 16 would be a great one. Then episode 18 and 20. 18 was Bobby Nicely, and 20 was Suzanne Livingston.
Mm-hmm. Wait, you missed Jason Riviero.
I just think he's a little different. I was going to do him after.
Yeah, go ahead. So
those are both IMB owners that are successful and really have a great culture. And I think on both episodes, opposite ends of the app, from sea to shining sea.
Mm-hmm.
And I think you could tell you and I during those were very, we really enjoyed it. And we're honored to have IMB leaders. I mean, you're talking 500 plus employees, running companies on great culture, winning in this environment, seen as beacons of opportunity. They were so different, but they were the same in prioritizing, obviously. Those are hard guests to always get because everybody's always asking them to do things. And it was great to have them on the show.
But the fact that we got a chance to see them, how much they actually, what they're doing to care, not just saying I care, but seeing how they share to care with their staff was pretty amazing. Suzanne saying that when they were more profitable, doing a profit share. I mean, those were all big. Those are big deals.
Yeah. And then the biggest deal might have been Jason Rivero. I mean, he's president of NAREP, 40,000 members to it, right? And I think I just wish the lending industry, and that's the point of the show, would hear that, and this is my one frustration with the Mortgage Bankers Association. Yep, I'll be on record saying it. They are almost promoting staying stuck in your old ways. And I don't see, and maybe because they have to, or that's what trade groups kind of have historically been, but NAREP has done a great job of it's not just real estate agents. They promote entrepreneurship within the agents. They promote education within their actual base to educate their family. But I just meant like you need alternative revenue opportunities.
I think one of the best things that I got out of that show was if you're a salesperson or a business owner, you don't even have to be in the mortgage industry. If you're a business owner, meaning that you could be an originator, you could be a salesperson, you could be a real estate agent, whatever, is that as long as you have the willingness to stay nimble, be open to education, be open to change, and being open to learn about how to change, and instead of being stuck in with where you're at, then the ability to grow will allow the world to be your oyster. And I think that Jason really represented that really well in some of the questions that we asked him, on his willingness to say, this is what we have done, this is what we are doing, and this is where we're going as a result of this change. And this is where other agents, originators, and companies can do with us in order to create better change for the industry, not just for the mortgage industry and also the real estate industry. So that was a really special interview for us to be able to go through the what NAREP is doing, which is different from the MBA. MBA is a different animal. Maybe you'll go on record. I'm not sure if I want to express everything I want to do just yet, but I agree with a lot of aspects of how you're saying that, Mike.
They need to promote that. You need to ask, how can we get more revenue opportunities? That it has to be an equity. It has to be, obviously, I think it's just a mindset, right? And maybe it's just with speakers. I'm not saying, it's legislation, education, and networking. So maybe it's when you network, but sometimes it just feels, Mike, like when I'm giving thought-provoking ideas, I'm being treated the same way I was being treated in 2014. And all I was trying to do was tell people to have an app in Google Play and Apple. And there are some now that they don't have one in there right now, and they haven't called me. Some that are canceling the well-known app. And so then they're just taking the app out of the store rather than calling me. Or most of them have that app in the store. That's what I told them in 2014. And, and it's like you speak up against, or you just say some things that are pretty obvious because consumers are acting this way. That should be promoted, not considered like, against the grain.
Can I digress for just a moment here? There's two apps which are fairly well known that I was attempting to use last year as a retail originator. I'm almost afraid to speak negatively about it. I would just say I didn't have a positive experience. The first one was the Surefire CRM, which I didn't have a positive experience with. And Mortgage Coach, I had been traditionally using since the early 2000s, by the way. And that was really clunky back then as well. It's okay. It's still clunky. I think there's more efficient ways to promote fiscal literacy and put out better product for that. I'm not sure how they're going to do it because they're a pretty large animal. Dave's done a pretty good job of changing the aspects of how originators can educate themselves on fiscal literacy, and as a result, educating the consumer borrower. The app isn't so great, but I think that as an industry whole, there's been a lot of good service as far as the goodwill of his intention. Normally, when you have good intentions, it's a path in a different direction. But I think in his favor, his path has been very positive for the industry. So, as we talk about the goodwill back into the industry, and apps, Um, the apps aren't great, but at least the representation by the leaders are good.
Yeah, without a doubt. I mean, the amount of content that Dave puts out for free on
Yeah.
YouTube
It's amazingly awesome, actually.
surprises me they don't go back and chop that up more and retarget it, and maybe maybe there's pixel stuff you can't do.
maybe. And then to close out our season with 2 weeks ago with CMG at the Spotlight. Great show. I really enjoyed talking to Courtney and Paul, and any IMB leader who would like to figure out how to get two opposite ends, servicing and sales, together to actually communicate so that they can coordinate with their origination team to go back into their database and be good for their database to generate more future business. That was an amazing conversation for the both of them to have together. I'm sure they've had closed door conversations, but they got pretty raw as far as I was concerned about asking each other questions. And some of the questions that we asked are like, I don't know, what do you think? I'm like, oh wow. So it was a great show. If you're a small IMB and you want to grow and figuring out servicing as well as sales, that's a great show to listen to for that.
Yeah, without a doubt. They got their flowers a couple times during this show because it was just it was a big land for us. And some of these people are booked out, weeks and months in advance, and we appreciate them all taking the time. And if you're interested in joining us for season 3, we are beginning our booking now, and we will see you next week on episode 1 of season 3.